Every paycheck you move money into savings, $150 here, $200 there. You don't splurge on things you don't need. You don't lifestyle creep after every raise. You're disciplined, responsible, doing the thing everyone told you to do, and then one afternoon you're sitting there looking at your savings account, $8,000, maybe $12,000, and something feels off because the number barely moved from last month. You're adding to it, but it doesn't feel like it's going anywhere. And then you hear someone casually mention that their investments returned 11% last year, and you do the quiet math in your head. Your savings account paid you maybe $40 in interest all year. That's when the question hits you. Am I doing this completely wrong? Here's the truth and nobody tells you clearly. Saving money is not the destination. It's the launch pad. And most people never leave it. Not because they're lazy, not because they don't care, but because nobody ever showed them the exact moment to stop saving and start investing, or more accurately, how to do both at the same time. So in this video, I'm going to walk you through the exact step-by-step path from saving to investing. Not theory, not vague advice. The actual sequence in order so you know precisely where you are and what move comes next. My name is Cap. If you're someone sitting on savings but unsure how to make that money actually work, hit subscribe and give this video a thumbs up. Let's get into it. First, let's fix a misunderstanding that keeps people stuck for years. Saving and investing are not the same thing. They are not interchangeable. They have completely different jobs. Saving is protection. It keeps your money safe, stable, and accessible. It doesn't grow much. It's not supposed to. Its job is to be there when you need it. Investing is growth. It puts your money to work in assets that increase in value over time. It fluctuates. Sometimes it drops. But over long periods, it has historically been the primary engine of real wealth. The problem is most people think of these as one category. I'm saving for the future. But future saving and future investing are completely different strategies with completely different outcomes. Here's a number that makes this real. If you put $10,000 in a standard savings account earning 1% annually, in 20 years you have roughly $12,200. That same $10,000 invested in a broad market index fund, historically averaging around 9 to 10% annually, grows to somewhere between $55,000 and $67,000 in the same 20 years. Same money, same person, completely different outcome. The only difference is the decision. And that decision starts with understanding exactly when saving should stop being your only move. Step 1. Build your financial floor first. Before a single dollar moves into investments, you need a real emergency fund, not a vague goal, an actual number. The standard guidance is 3 to 6 months of living expenses. That means if your monthly costs are $2,500, your emergency fund target is somewhere between $7,500 and $15,000. Sitting in a savings account, untouched. Now here's why this matters more than most people realize. The number one reason people panic sell investments is not a market crash, it's a personal cash emergency, unexpected car repair, medical bill, job loss. When life breaks and you have no buffer, you raid your investments, usually at the worst possible time, usually at a loss. Your emergency fund is not a boring placeholder. It is the shield that protects your investments from your own life. Until that floor exists, investing is actually riskier than it needs to be, so build it first, fully, then move. Step 2. Identify what's actually available to invest. Once your emergency fund is solid, most people make the same mistake. They look at their savings account, see a number, and think all of it is investable. It isn't. You need to separate your money into 3 clear categories. Category 1. Fixed obligations. Rent, bills, subscriptions, minimum debt payments. This money is already spoken for. Category 2. Variable monthly spending. Food, transportation, social, lifestyle. You need a realistic number here, not an optimistic one. Category 3. The gap. Whatever is left after 1 and 2. This is your investable surplus. Most people have never actually calculated this number. They have a general feeling. But feelings are not a plan. Sit down, run the actual numbers, and find the real gap. Even if it's $75 a month, even if it's $200. That number is where your investing life starts. Step 3. Open the right account before you pick any investment. Here's where beginners skip a step that costs them real money. They rush to pick a stock or fund without first choosing the right account to hold it in. Account type matters because of taxes. In the US, a Roth IRA lets your investments grow completely tax-free. You contribute after-tax dollars now, and when you withdraw in retirement, you pay zero tax on the gains. For most people starting out, this is one of the most powerful tools available. If your employer offers a 401k with a matching contribution, that match is the closest thing to free money in personal finance. At minimum, contribute enough to capture the full match before anything else. The order of priority typically looks like this: employer match first, tax-advantaged retirement account second, regular brokerage account third. The exact account names vary by country, but the principle is universal. Use the most tax-efficient structure available to you before you worry about what to buy inside it. Step 4. Start with one simple investment. This is where people overthink themselves into paralysis. They research ETFs for 3 months. They watch videos about sector rotation. They read Reddit threads comparing 16 different index funds. And then they do nothing because they're waiting to feel ready. Here's what actually works. Pick one broad market index fund. Total market or S&P 500. Low expense ratio, ideally under 0.10%. Buy it. That's it. You are not trying to beat the market. You are not trying to find the hidden winner. You are buying the entire market at low cost and letting compounding do the work over time. Warren Buffett, arguably the most successful investor alive, has publicly said that for most ordinary investors, a simple low-cost S&P 500 index fund will outperform the vast majority of professional fund managers over the long run. That's not a beginner strategy. That's the strategy. Step 5. Automate everything and remove yourself from the equation. Here's the psychological trap nobody warns you about. Even after you start investing, your brain will try to interfere. Markets dip and your instinct says sell. Markets surge and your instinct says buy more. You read a headline and suddenly reconsider everything. This is normal, and it is also the most reliable way to underperform. The solution is simple. Automate your contributions so the decision is already made before your emotions get involved. Set a fixed amount to transfer from your bank to your investment account on the same day every month. The moment your paycheck hits, the money moves. You never see it sitting there tempting you. This strategy is called dollar cost averaging. You invest a fixed amount consistently regardless of market conditions. When markets are down, your money buys more shares. When markets are up, your existing shares are worth more. Over time, it smooths out volatility and removes the pressure of trying to time anything perfectly. Because here's what the data consistently shows. Time in the market beats timing the market. Every time. Now let's put the whole path together. Step 1. Build a real emergency fund. 3 to 6 months of expenses. This is your financial floor. Step 2. Calculate your actual investable surplus. Run the real numbers. Find the gap. Step 3. Open the right account first. Capture any employer match. Use tax-advantaged accounts before taxable ones. Step 4. Start with one simple, low-cost index fund. Don't overcomplicate it. Step 5. Automate contributions and stop watching daily. That's the entire system. Not complicated, not exciting, not the thing people make viral videos about, but it works, and it keeps working, quietly in the background, while you get on with your life. Because here's what most people only understand after years of trying to do it the complicated way. The goal was never to be impressive at investing. The goal was always to stop trading time for money forever, and that goal has a very simple path. You just have to actually walk it. If this helped you see the transition clearly, hit subscribe, and tell me in the comments. Are you still in the saving stage, or have you already taken your first investing step? I want to know where you are, because wherever that is, that's exactly the right place to start.